If your bank starts telling you no, it's not because you became a worse customer, it's because money got expensive. And the middle class is where banks cut first. One morning, your credit card limit drops from 10,000 to 6. No late payments, no job change, nothing. The number is just smaller, or your APR jumps from 19% to 24, or you try to refinance your car and the rate comes back 2 points higher than you expected, or your home equity line, the one you opened years ago just in case, is suddenly frozen the first time you actually need it. None of this is random, and it's not about you personally. It's your bank fighting a war you can't see, a war over deposits. When banks have to pay more for money, they reprice everything. Credit gets more expensive, standards get tighter, risk gets cut, and families in the middle lose access first. I'm Professor David O'Brien. I've spent 20 years studying how banking incentives turn into household costs, how a quiet shift in funding becomes a loud problem in your life. And what's happening right now is a textbook repricing event, systematic, low drama, and aimed directly at people who thought their credit was safe. Here's what we're going to do today. First, I'm going to show you why the middle class loses credit access before anyone else when deposit costs rise. Then we'll talk about who still gets credit when you don't and why that feels so unfair. And finally, I'll give you the early warning signals that show up weeks before the headlines ever do, plus a simple way to prepare without panic. This is analysis and education, not personal financial advice. I'm not telling you what to buy or sell. I'm showing you the mechanism so you can see it coming and prepare. Now let me give you a win in the next 90 seconds. Something simple that tells you if the freeze is already touching your life. Open your credit card app. Write down 2 numbers, your current APR and your current credit limit. Do that for every card you have. Now go into your email and search messages from your bank in the last 60 days. You're looking for 4 phrases: changes to your account, updated terms, adjusted credit line, and enhanced verification. If you see any of those, screenshot them. That's your baseline. Next, if you have a home equity line of credit, log in and check one thing. Can you still draw on it right now? Not in theory, right now. And finally, if you used to see pre-approvals, credit cards, personal loans, auto offers, check if they're still showing up. When banks tighten, pre-approvals disappear first. That's your early detection system. 90 seconds. No spreadsheets, no jargon. Now let's talk about why you need it. The deposit war is simple. Banks need deposits to function. Deposits are the cheapest fuel they have. You park $10,000 in a checking account. The bank pays you almost nothing. Then they lend money out at a much higher rate through credit cards, auto loans, personal loans, mortgages. That difference, what they pay you versus what they earn lending, is the business model. But deposits are leaving. Money market funds are paying 4 to 5% right now. People are moving cash out of bank accounts and into those funds. That means the bank loses cheap fuel. So the bank has 2 choices: pay more to keep deposits, or replace them with other funding that costs more. Either way, the bank's cost of money rises, and banks don't absorb higher costs. They pass them on, they reprice credit, they tighten standards, they cut risk, and the first place they cut is the middle. Let me show you what that looks like when it lands on your life. Say you have a credit card with a $10,000 limit. You use about $2,000, you pay it down most months. Your credit is decent, 720, 740. Not perfect, but responsible. Here's how the bank sees you. You're stable, but you're not their most profitable customer. You're not paying massive interest every month. You're not carrying huge balances. You're also not risky enough to be priced like a distressed borrower. You're just middle. 6 months ago, that was fine. Today, money is expensive. The bank needs to reduce exposure without losing much revenue. And the easiest place to do that is the customer who isn't paying enough interest to justify a big open credit line. So your limit drops. 10,000 becomes 6. No negotiation, sometimes no warning. You find out when a purchase gets declined and your stomach drops because you didn't do anything wrong. Or take APR repricing. You've had the same card for years. The rate was steady at 18.9. Now it's 23.9. You didn't trigger a penalty, no missed payments, no overlimit, you just got reviewed. The letter will call it something like market conditions or account review. Translation, the bank's cost of money went up and they're pushing that cost onto you. If you're carrying a $5,000 balance, that jump cost you real money every year. You didn't change. The bank's funding changed. You're paying for it. Now look at auto loans. You walk into a dealership with a 730 score. 2 years ago, you're approved fast and the rate is competitive. Today, same score, same income, same job. The rate comes back higher. The dealer shrugs and says rates went up. But it's not just rates. It's that banks aren't competing as hard for your business when funding is expensive. They approve fewer people. They charge more for the same risk. And the middle gets priced first because it's the biggest pool they can tighten without losing their best customers. Refinancing is the same story. You try to refinance to lower your payment. Suddenly, you need more documentation than you've ever been asked for. More pay stubs, more tax records, more verification. And after weeks, the offer is barely better than what you already have. That's not you getting worse. That's the bank getting stricter. And then there's the one that feels like a betrayal. Home equity lines of credit. You have equity. You opened a HELOC years ago as a safety net. You didn't touch it. You did everything right. Then you need it for a roof, medical bill, emergency repair, something real. And when you log in, it's frozen. No letter, no phone call, just a message like, your line is under review. You call and they tell you they're evaluating risk across home equity products. That's not a banking error. That's liquidity management. When money is expensive, banks don't like open promises, lines that can be drawn at any time. So they reduce those promises quietly. And you discover it at the worst moment, when you needed the backup plan you thought you'd already secured. Let me make this land with two scenes. Scene 1. You're a teacher, married, 2 kids, household income around $90,000. You've got a mortgage, a car payment, and some card debt you're working down. Your score is around 710. You get an email. Important account update. Your limit drops. Your APR jumps. You call. They tell you it's routine. Nothing you did wrong. Just policy. That's the shock. There's no villain in your story. No mistake to fix. Just a system tightening around you. Scene 2. You're self-employed. Good income, but it fluctuates. You used to see pre-approvals all the time. Then they vanish. You apply anyway. Denied. Your score is basically unchanged. You apply elsewhere. Denied again. You call a bank and they tell you they've adjusted underwriting criteria and want more stable income documentation. Your income didn't suddenly become fake. Their tolerance changed. This is what a middle-class credit freeze looks like. Not a crash, not a headline, friction everywhere, all at once. And it's being driven by one thing. Banks are paying more for deposits, so they're protecting their margin by cutting risk and repricing credit. Now let's talk about who doesn't lose access, because that's where it starts to feel unfair. High net worth customers are less likely to be cut first. If you keep large deposits and investment accounts at the bank, you're valuable. The bank doesn't want to lose you. They will often prioritize you, offer you better service, and keep your credit more stable because you generate fee revenue and you're sticky. People with significant assets inside the same institution, checking, brokerage, mortgage, business accounts, have leverage without realizing it. They're harder to replace. So when the bank tightens, it tightens around them. Corporate and commercial clients are also insulated in a different way. Business deposits are gold in a deposit war. Banks may tighten terms, but they fight to keep those relationships because the deposits matter. And prime borrowers, perfect-looking profiles, still get offers because banks can price them and still win. They're treated as safe margin. The bank cuts the middle to preserve capacity to lend where the balance sheet looks the cleanest. So you end up with a two-tier reality. People with assets and leverage keep access. People in the middle, responsible but not lucrative, get squeezed first. Not because it's personal, because it's math. Now, if you lived through 2008, this is where your memory kicks in. This isn't 2008 again. The system isn't collapsing from bad assets in the same way. But the pattern rhymes. When money gets expensive, credit becomes a weapon. Not subprime this time, just friction. Higher costs, tighter terms, more documentation, longer waits. And here's what makes it scarier than a headline crisis. It happens quietly. No emergency meetings on TV, no dramatic bank failures. Just small changes that add up until one day you realize your financial flexibility is gone. So how do you see it coming before it hits you hard? Start with your credit limits. If you see limits dropping across multiple cards without obvious reasons, that's exposure reduction, that's the bank tightening. Then APR changes. If your interest rate rises without penalty triggers, that's repricing. The bank's cost went up, and they're moving it onto you. Watch documentation requests. If borrowing suddenly requires more proof, more verification, more back and forth, that's a conservative shift. It's not customer service, it's risk control. Watch time. Approvals that used to take a day now take a week. Instant decisions become manual review. That's not incompetence, that's caution. Watch disappearing pre-approvals. If you used to get offers and now you don't, the bank narrowed its funnel. They're marketing to fewer people, usually the top tier. Watch fees, monthly account fees, minimum balance thresholds, overdraft charges, wire fees, maintenance charges. When margins get squeezed, fees creep in because they're easier to implement than raising headline interest rates. And watch the language. Phrases like account review, updated underwriting standards, portfolio optimization, enhanced verification, risk management. Those aren't meaningless. They're code. They tell you the tightening is already underway. These signals don't show up on cable news. They show up in your inbox, in your app, and on your statement. If you know what to look for, you can see the freeze 60 to 90 days before most people even realize it has started. So what do you do about it without panic? First, reduce dependence on revolving debt. If you're carrying a credit card balance, that balance is variable rate exposure in a tightening cycle. Pay it down if you can. If you can move it to a fixed rate structure with better terms, consider it. Revolving debt is where repricing hurts fastest. Second, build a 90-day liquidity plan. Not doomsday, just reality. Make sure you can cover 3 months of expenses without relying on new credit, because if credit tightens, you need time to adjust. Accessible cash buys time. Third, review variable rate debt. If you have variable rate exposure, HELOCs, certain loans, understand what happens if rates stay high or if terms tighten. Certainty beats surprise. Fourth, open backup access before you need it. If you have home equity and you've been considering a HELOC, the best time is when banks are still willing to approve. If you've been thinking about an additional credit line for flexibility, the time is before underwriting tightens further. Access is easiest to get when you don't urgently need it. Fifth, simplify so you can monitor. The more accounts and cards spread across institutions, the easier it is for changes to slip past you. Fewer moving parts makes repricing visible. And sixth, read what the bank sends you. I know it's boring. That's why it works. The biggest changes arrive in fine print, not headlines. Once a month, scan your bank emails. Open the PDF notices. Look for any adjustments to rates, fees, limits, or terms. None of this is about fear. It's about preparation for months of friction. Higher costs, tighter access, more paperwork, longer waits. If you're ready for that, it's annoying but manageable. If you're not, it can derail you right when you needed flexibility most. Here's the line to remember. You didn't suddenly become risky. The bank's funding became expensive. The deposit war is real. Banks are paying more to defend deposits and replace the ones that left. That cost gets passed down. And because the middle class is the biggest, most adjustable layer on the balance sheet, it feels it first. So watch your limits. Watch your APR. Watch your terms. The freeze doesn't start with a crisis headline. It starts with a quiet no, a smaller number in your app, a longer approval, a line that's suddenly under review. You can't stop the repricing cycle, but you can stop it from surprising you. Check your credit lines tonight. Write down your APRs, look for those phrases in your email, build your 90-day plan, and secure backup access while you still can. And if you're already seeing it, if your limit dropped, your APR jumped, your HELOC got frozen, or pre-approvals disappeared, leave a comment with what hit first: limits, rates, fees, or friction. Because the more people recognize the pattern, the harder it is to hide in fine print. This isn't a collapse, it's a repricing. And in a repricing, the people who see it coming protect what they have. The people who don't see it coming lose access they thought was guaranteed.